Hey, we should give you a shout out too. The Global Allocation Fund that you oversee did incredibly well for 2020. It was up 21.2%, I think, and that was 778 basis points, better than the benchmark. Huge outperformance there. But it makes me wonder where you think things are headed this year based on that performance. You've been really positive on the markets, and do you see that continuing even with, the speculative stuff, all of these things happening in the background? My guess is you're still overwhelmingly positive about where you see things headed.
I am. I mean, Becky, I think, there's one thing. You always try and, it's like a math equation. Every time you're thinking about where do you invest, and you try and figure out what is your constant and what is your variable within the portfolio. I think the constant is the economy is going to grow faster than people think. And the amount of stimulus, the amount of monetary policy that is going to support that stimulus, which we're going to hear from the chair today, is extraordinary. So the growth is going to be good. The companies that are going to pivot off of that, we saw Microsoft last night. It'll be interesting to see the tech earnings that come out on the backside of it. So what we try and do, by the way, the positioning is very different than last year. Last year, we used a lot of interest rate exposure in our portfolios as the Fed was dropping interest rates. Today, we're using much less of that and holding more cash, more as a hedge, more as ballast in the portfolio. And quite frankly, we've shifted around some of our technology holdings where some of the big tech we've reduced a bit. We still like it a lot. But some of the big tech we've reduced a bit, more semis, parts of software. And by the way, not parts of software, which to your earlier comment, have gotten a bit overzealous. So we shifted some things around, more financials this year than we had last year. So definitely a different framework for how you think about your portfolio in 21.
Why more cash? You're holding that as a hedge against what?
Yeah, so every time, we try and build balance in our portfolios and think about, okay, what did treasuries do for you? What did high quality fixed income assets do for you in the portfolio? They provided ballast. They gave you some price return in times you needed it. But when interest rates go to zero and we're financing investment grade companies, some of the issuance, we've had about $100 billion of investment grade supply this year. A third of it has come inside of 1%. The upside return, the convexity of holding some of those high quality assets is not great today. Things like agency mortgages, which gave you some upside, gave you some carry in the portfolio, given how much the Fed has bought, they're not interesting. So we've made the decision that let's just hold more cash. The cost of holding cash is not that expensive, and then take the risk where we want to take the risk. And so, it's a really different framework. And also, by the way, having that cash allows you to take advantage of some pretty significant opportunities that happen in the market day in and day out, new issue calendar that comes to the market. So, cash is your friend in an environment like this.
Yeah, it certainly makes you more flexible. Are you waiting for pullbacks in the market to do things? Or are you looking more specifically in certain sectors, waiting to be opportunistic about, like you said, new issuance coming on?
So, we're in a robust new issue period of time. And so there's every day there's some things to look at. And so we're obviously doing some of that. And then the other is, I'm not sure, you get days like today where the volatility is extreme and you get a pullback. I don't know that we're necessarily going to get one, but I wouldn't write it off either, given, as I think y'all were describing earlier, there's been some froth in the markets that tends to get some pullback before the markets cleanse themselves and then rally again. So we are holding it in case you get some of that. And then, but there is, listen, in the market today, given what's happened to fixed income assets, given what's happened to equities, the opportunity set is just not what it was 6 months ago, a year ago, or 3 months ago for sure. And so, anyway, the cost of holding cash and then waiting for things to develop is negligible.
Shepard Smith here. Thanks for watching CNBC on YouTube.